Do you believe you can become a CROREPATI while earning just 10,000 rupees a month? Sounds impossible, right? But let me tell you, it's not just possible, it's achievable with the right strategy and patience. In today's video, I'll guide you step by step on where to invest, how much to invest, and most importantly, how to multiply your wealth over time. By the end, you'll have a clear roadmap to financial freedom, and trust me, don't miss a single step. This journey could transform your financial future. Now let's dive in. If your salary is 10,000 rupees a month, the thought of saving and investing might feel overwhelming. After all, it's not easy to manage everything within such a limited income. But here's a golden rule. No matter what you earn, always invest at least 20% of your income and increase the investment money by 10% every year. 20% means 2,000 rupees a month if you're earning 10,000 rupees. And 20% is minimum to invest. You can increase this amount if you want by looking at your personal needs and wants and how you manage your 10,000 rupees salary. Note, all the percentage rate of interest are taken based on the historical data of 10 years of the respective investment options. But where should you invest this money? This is the part where most people get stuck. Let's break it down. If you want safety and stability, fixed deposits (FDs) might seem like an obvious choice. Over the last decade, FDs have delivered an average return of 6%. Sounds good, right? But here's the catch: inflation. If inflation grows at 6%, your real wealth remains stagnant. Because let's assume if you invested 100 rupees this year, it will definitely grow till 106 rupees next year. But due to inflation rate also being 6%, the value of your invested money will remain stagnant. And that is very important for you to understand. So you can invest in FDs if you want. Let's see what will happen ahead in this video, so stay till the end. Next up is real estate. Now you might wonder how someone with a 10,000 rupee salary can afford real estate. The answer lies in REITs, real estate investment trusts. These are like buying a slice of real estate through the stock market. For as little as 400 to 500 rupees, you can invest in properties generating rental income. But what kind of returns can you expect? Stick around, I'll reveal that soon. Now let's talk about corporate bonds. These are loans you give to companies and in return, you earn interest, around 7.5% annually. Safer than stocks and better than FDs, corporate bonds are a great choice if you're looking for steady growth. But if you want to beat inflation and create real wealth, you'll need to explore equities. Equities, or stocks, are where your money truly multiplies. For beginners, index funds are a fantastic choice. These funds invest in a diversified portfolio of top-performing companies, reducing your risk while delivering consistent returns. If you had invested in Nifty 50 or Mid-Cap 100 over the last decade, your returns would have been in double digits. And for those willing to take higher risks, small-cap stocks have historically delivered a whopping 18% return. Now here comes EPF, Employee Provident Fund, which gives an annual return of 8.38%, which is very good. So if you are an employee, you can invest all your money in EPF because this is also risk-free as they are government-backed. Next option is gold. Gold is also a very good option, provided on an average 10.41% rate of interest. And it is important to note that to invest in gold, I does not mean to invest in physical gold, because the making charges in GST will leave its no value. So here we will invest in sovereign gold bonds. These are the government bonds that are issued in gold. Here, you will also get the appreciation of the gold. Still not convinced? So now let's compare them. This will be the most important part of this video. Let's see what happens over time. If we invest in these options starting from today, this part will be the complete analysis of the amount you can expect 10, 20, and 30 years after the investment of 10,000 rupees. And we will see here if any options really have the potential to grow our wealth to 1 crore or not. Expanded scenarios. When it comes to building wealth, your investment choices can drastically impact the outcomes over time. Let's explore various scenarios and what they teach us about the power of compounding, risk, and diversification. Scenario 1. 100% in fixed deposits (FDs) are often the go-to for safety, but their returns rarely beat inflation. Over 10 years, 5 lakh rupees grows to 3 lakh rupees in real value after inflation. By 20 years, your 11 lakh rupees has the purchasing power of just 5 lakh rupees. After 30 years, 75 lakh rupees would be worth a mere 17 lakh rupees in today's terms. The lesson here? FDs are a safe harbor, but they cannot create significant wealth over time. Scenario 2, 100% in small cap equity investments, especially small caps, are a different story altogether. Over 10 years, your 9 lakh rupees retains 6 lakh rupees of real value, and by 20 years, 80 lakh rupees grows to 30 lakh rupees in purchasing power. In 30 years, your wealth balloons to 5 crore, 45 lakh rupees, with a real value of 1 crore, 25 lakh rupees. The exponential growth highlights the wealth-building potential of equity, albeit with higher risks. Scenario 3, 100% in real estate investment trusts. REITs offer a middle ground between growth and stability. After 10 years, your 6,50,000 rupees translates to 4 lakh rupees in real terms. In 20 years, 25 lakh rupees equals 11 lakh rupees, and in 30 years, 120 lakh rupees has a purchasing power of 40 lakh rupees. REITs provide moderate returns and stability, but fall short of equities in delivering long-term wealth. Scenario 4, 100% in corporate bonds. Corporate bonds are safer than equities, but tend to underperform in the long run. Over 10 years, your 6 lakh rupees retains 3,80,000 rupees in value. By 20 years, 21 lakh rupees translates to 9 lakh rupees, and in 30 years, 1 crore rupees equates to 30 lakh rupee. Scenario 5, 100% in gold. Sovereign gold bonds. Gold has traditionally been seen as a hedge against inflation, and it shows here. After 10 years, your 7,50,000 rupees has a real value of 5 lakh rupees. In 20 years, 35 lakh rupees equals 16 lakh rupees, and by 30 years, 2 crore rupees translates to 60 lakh rupees. While gold provides decent returns, it lacks the explosive growth potential of equities. Scenario 6, balanced allocation, 60% equity, 20% bonds, 10% REITs, 10% gold. Diversification emerges as the winning strategy. Over 10 years, 8,50,000 rupees retains 5,80,000 rupees in real value. By 20 years, 50 lakh rupees equals 18 lakh rupees, and in 30 years, 3 crore, 75 lakh rupees has a purchasing power, 1 crore, 30 lakh rupees. By combining the growth of equity, the stability of bonds, and the inflation hedge of gold, this balanced portfolio delivers superior returns while minimizing risks. These scenarios prove that no single asset can win every financial race. The key lies in understanding your goals, balancing risk and reward, and leveraging the magic of compounding over time. Now next, we will see the optimal allocation of 10,000 rupees by age. Your investment strategy should evolve with age to align with your changing financial goals and risk tolerance. In your 20s, it's all about maximizing growth. This is the time to take bold steps, as you have decades to recover from potential market fluctuations. A suggested allocation is 10% in fixed return investments for stability, 40% in Nifty 50 for consistent returns, 25% in mid-cap 100 for higher growth potential, and 25% in small-cap 250 to capitalize on aggressive gains. This strategy can yield an impressive average return of 13% annually, setting a strong foundation for wealth creation. As you transition into your 30s, responsibilities grow, and so should your focus on balancing risk and reward. Increasing your fixed return allocation to 20% provides a cushion against market volatility. Maintaining 40% in Nifty 50 ensures steady growth, while 25% in mid-cap 100 and reducing small-cap 250 to 15% strike a balance between growth and safety. This revised portfolio targets an average return of 12.18% annually, aligning with your goals of building wealth while safeguarding your family's financial security. In your 40s and beyond, wealth preservation becomes the priority. A larger portion, 30%, should go into fixed return investments to provide stability and predictable income. Allocating 50% to Nifty 50 ensures continued participation in equity markets with lower volatility, while reducing mid-cap 100 to 15% and small-cap 250 to 5% minimizes risk exposure. This conservative strategy aims for a respectable return of 10.84% annually, allowing you to enjoy a secure and comfortable lifestyle while protecting the wealth you've built over the years. By adapting your investments at each stage of life, you ensure that your portfolio not only grows, but also aligns with your evolving priorities, creating a balance between risk and reward at every age. Key takeaways: FDs and bonds, safe but low returns, primarily to preserve capital. Gold, great hedge against inflation, but not for aggressive wealth building. REITs, excellent for steady returns and diversification, especially for those who can't afford physical real estate. Equity, small cap, high risk but unparalleled long-term returns, ideal for young investors. Balanced portfolio, the best of both worlds, growth from equity and safety from bonds, REITs, and gold. Want to grow your money faster? Adjust your portfolio based on your age and risk tolerance. Powerful conclusion. Building wealth isn't about luck. It's about smart decisions, consistency, and playing the long game. Remember, every 2,000 rupees you invest today is a seed that could grow into a forest tomorrow. But only if you start now. And as I always say, the best way to predict your financial future is to create it. Start today because your future self will thank you. Don't forget to like, share, and subscribe for more life-changing financial insights. See you in the next video.